Over the last few months, we've seen the stock market drop over 30%, unemployment go up to 14%, which is the highest it's ever been, and entire countries close down. Yet, there's been people who've made billions due to this economic downturn. Economic recessions are stressful for anyone, but they can also present with great opportunities for those who know what to do. With the potential recession in our hands, it's a good time to talk about the opportunities a recession brings to those who know what to do. So in this video, let's go over 10 ways people have taken advantage of economic recessions to get rich. Number 1. Short selling. Short selling is an interesting investment strategy that experienced investors can do to profit when stock prices crash. Here's how short selling works. An investor borrows stock from a broker and sells the stock in the open market. And as the market drops, the investor buys back the shares at a lower price, keeping the profit. For example, let's say that our friend Tom here borrowed 1,000 shares of company X for $100 per share. This means he borrowed $100,000 worth of stock from a broker. He then turns around and sells this stock in the public market, giving him $100,000 in cash. And let's say that the stock prices go down from $100 to $60 per share in the market crash, losing 40% of its value, which is similar to the recent drop in the S&P 500 or even higher for companies in the travel industry. So now, with the stock only worth 60% of its original value, Tom uses the $100,000 he got by selling the original stock to buy back the 1,000 shares he owes, this time paying only $60,000 for the 1,000 shares. This means that he now has $40,000 in cash and $60,000 worth of stock. He gives back the original 1,000 shares to his broker while profiting $40,000 from the drop in value. Of course, Tom would have to pay interest to his broker for the stocks he borrowed. An example of this is hedge fund manager Bill Ackman, which according to Business Insider made a whopping $2.6 billion as the markets dropped. While most people lost money, Ackman gained billions. Now, this is an advanced strategy and carries a high level of risk. If the stock prices go up instead of going down, short sellers lose money. And since there's no limit on how high a stock can go, theoretically, there's no cap on how much short sellers can lose. Number 2. Buying stocks at a discount. As stock prices go down in value, investors are able to buy stocks of established companies at a lower price. According to Tony Robbins' book, Money Mastered the Game, most people panic and sell their stocks as the markets go down. But if we take a look at historical data, this can cause investors to miss out on potential growth. If we take a look at the history of the market, every recession is followed by an expansion, which means that a recession can be a perfect time to buy underpriced stocks, especially of well-established companies that are not likely to fail. For example, according to Business Insider, Amazon lost $86 billion in market cap after the first quarter of 2020. Still, Amazon is one of the strongest companies in the world and unlikely to disappear in the next coming years. This means that stock prices are likely to recover since the company is still highly functional. Imagine going to the store and having everything in the store 20 to 40% off. To a smart investor, a market crash is like going to the store when everything is on sale. Number 3. Government bonds. As the economy slows down, the government needs money to try and stimulate the economy, which means the government is either printing money, borrowing money, or both. When a government needs money, the government will issue government bonds, what is called treasury bills, that investors can buy. In other words, investors lend money to the government to be paid back with interest. Since these are backed by the government, unless the government collapses, investors will not lose their investment, making this a very safe investment. In times of trouble, bonds tend to rise in value. Since they are loans that pay interest backed by the government, they become more appealing to investors whose stocks are losing value. As bonds go up in value while stocks drop, investors incorporate bonds in their investment strategy to limit their losses in a market crash. Number 4. Adapting and restructuring. It is no secret that many businesses are taking a big hit right now, especially those operating brick-and-mortar businesses. And this particular recession is an opportunity for those ready to adapt to be able to take advantage of the internet, to create new products, new services, or new systems to deliver already existing products. Many people refer to an economic recession as a shift in the economy. Historically, the economy always recovers, but with it, there is a shift in the people and businesses that come out ahead. In this competitive world, the ones who adapt to the new times and new market demands win. And economic recessions bring to light a lot of weaknesses in outdated business models. Companies like Uber, Square, or Slack were born in the middle of the 2008 market crash and became multi-billion-dollar companies. Number 5. Government bailouts. A government bailout is a cash injection from the government to a business to help it from going bankrupt. This is by either lending them money, buying stock or bonds, or simply just cash infusions. If a government thinks your failing business is an important part of the economy, for example, if you employ lots of people, or in the case of 2008, are a financial institution, then the government can step in to save the day. This is a big way some of the biggest companies in the world can benefit from a recession. For example, in 2008, the US government lent $17 billion to car makers GM and Chrysler to not go bankrupt, which helped them remain some of the largest car producers today. Number 6. Buying assets others can no longer afford. An economic recession inevitably means that there will be some people that have bought an asset they can no longer afford or will have to sell to survive tough times. This also means an opportunity for those who have cash in hand and can take over those assets. For example, in 2020, we have the highest unemployment rate ever recorded. This can lead to many people unable to pay their rent. This poses a problem for landlords who have mortgages on their properties and have to pay property taxes. And with a new law that states that landlords cannot evict tenants that are unable to pay their rent, landlords are in a tight spot, where some have to sell off a property because they can no longer afford it or in order to keep other properties afloat. The problem is, people are not buying properties right now, so in order to sell off a property, the price might need to be reduced. This is where an investor with cash is able to scoop up a property at a fraction of the price. Now, this doesn't have to be real estate. In times of crisis, those who are not prepared have more pressure to sell off things that they previously bought. This is where wealthy people can buy things that they wanted at a discount, like a rare painting or a collector's car. Number 7. Renegotiating. Since a recession is tough on everyone, especially businesses, this can be a good time to renegotiate terms or agreements with them. Businesses do not want clients to leave, especially in these tough times, so they might be more willing to agree to terms that they wouldn't otherwise. This works if you're a big company, but this can also work for the average person to negotiate things like utilities or even interest rates on loans. Many wealthy people take advantage of these times to renegotiate terms with suppliers, lenders, and service providers. Number 8. Taking over bankrupt companies. Unfortunately, recessions also mean that many companies go out of business. This also means that a bigger, more stable company can buy a smaller company in their industry or related to their industry for very, very cheap. This means that a bigger company can use this acquisition to expand their business because as they buy another company, they are potentially buying working infrastructures, contracts, clients, assets, intellectual property, and already trained people, which can cost more to build themselves than the price they paid for. They are potentially buying an already made system that can expand their business. For example, an airline company might be going out of business, but it can be taken over by another bigger airline. Now, this new airline owns the planes, the contracts, the routes, and the trained staff. Now, this bigger airline can now have higher reach than it did before. They can even renegotiate their terms to be more favorable. Number 9. Borrowing money interest-free. Typically, during a recession, interest rates on credit drop, some down to 0% to incentivize borrowing, which in turn allows increased spending, which stimulates the economy. Companies that are looking to expand or in some cases survive need money to do so. So they can either sell more shares of their company, which would dilute their existing shares and give up equity, or borrow money. And in many cases, especially when interest rates drop, it becomes cheaper to borrow money than to sell shares and give up equity. Now, a big company that does not actually need money might still borrow money. Since interest rates are low or free, they can use this interest-free money to buy back their shares at a cheaper price. Since stocks are down and likely to go back up, the company can buy back its own shares at a discount and make money as the markets recover. Number 10. Investing in companies that benefit from the recession. In most recessions, there are companies that suffer as well as companies that thrive. In this case, many travel-related companies are struggling, but many others like entertainment, e-commerce, and medical supply and prevention companies are thriving. Like we said before, some of the biggest companies we know were born in the midst of a recession, and chances are that there will be new companies starting up now that meet the new market demands. This means opportunity for those who have an eye to spot the next big thing to invest in. And as always, thank you for watching, and I will see you in the next video.